In this video, I'm going to be going through the template I've made for fundamental analysis on my portfolio tracker. So I'm going to break it down and go through each section of it and talk about what some of these terms mean. And then I'm going to be making a video with a worked example showing actually how to use this. So this is the template that I've made, and there's many ways of analyzing a stock fundamentally. And there's many different ratios and things out there. I've just picked something that works for me, and I'm just passing that on, and by all means you can use this in other ways as well. So I'm going to start with the first section. So this first section has got a few terms such as ticker, sector, company name, and things like that. So starting with the ticker itself, this is basically the abbreviation of the stock. Every stock has a ticker. So for example, the ticker for Apple is AAPL, the ticker for Broadcom is AVGO. So here's a table as an example from my tracker that you've got all of these tickers on the side and you've got the company names right next to it. It's basically just an abbreviation. So if I wanted to search an app for the stock, I don't need to search for the company name, I can just search the ticker. It's just there to make things easier. Moving on, you've got the sector. So the sector is essentially the niche that the company belongs in. So for example, companies such as Shell belongs to the energy sector, as that's an oil company. And as so, there are 11 sectors within the S&P 500. So you've got communication services, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, IT, materials, real estate, and utilities. So these are the sectors that are present within the S&P 500, and I think it's important to know about these because it helps when it comes to diversifying your portfolio. And this is just a graphical example as well of the S&P 500 and how the sectors make up different parts of it. The next thing is the market cap. So the market cap is the total value of a company's shares of stocks. So essentially it's a way of seeing how much a company is worth. And the way that is calculated is the share price times the number of shares outstanding. So just as an example, if I have a company and that company has 100 stocks in existence, and let's just say each stock is worth $10, that means the market cap of my company is $10 times 100 stocks, which is $1,000. That's what the market cap would be. It's important to know this because the bigger the market cap, the bigger the company. And if the company is a big company, it's going to be less risky in theory. And the opposite to that is the smaller the market cap, the smaller the company. And theoretically speaking, it would be much more risky as well. This is just a heat map showing the price changes of some of the companies. The reason I put this here is because the size of the square represents the market cap of the company. So for example, when you look at the semiconductors, you can instantly see Nvidia's the biggest one, the biggest market cap company within the semiconductors. And if you look within technology, you can see that Microsoft is the biggest. So similarly, you can see the biggest stocks within each sector, like healthcare, Eli Lilly, for example. Now, if I move on, the next thing is the PE ratio, which is short for price to earnings ratio. This basically shows you how much investors are willing to pay for each dollar of company profits. So the way it's worked out is you've got the share price divided by the amount of money that the company makes per share. The reason people look at PE ratios is because if it's a high PE ratio, it means investors expect the company to grow quickly, but it could also mean that the stock's expensive. And the opposite to that is if it's a low PE, it means a company might be undervalued or it might not be growing quickly. So it does need further research. The next thing is the percentage debt. So this is worked out by the amount of debt divided by the market cap of the company. The reason this is important is it shows you how much of the company's worth is made from debt. So if the company has a lot of debt, so a high ratio, that means it's going to be more risky because it's reliant on a lot of debt. So if the interest rates, for example, go high, then that company is in trouble because it's going to eat into their profits. And the opposite to that is a low ratio, so a low debt means that the company is not reliant on the debt, meaning that it's going to be more stable. So now I'm going to move on to the next section. So the next section talks about the company's financial side of things. So you've got things like revenue, margins, net income, earnings per share, and so on. So I'm going to go through these here. So the first thing I'm going to go through is revenue. So revenue in simple terms is how much money does the company make before any deductions from it. So imagine yourself having a lemonade stand. It's essentially how much money have you made from selling lemonade before you take out the costs, so the actual lemons, the sugar, the stall, or whatever. Then you've got the net income. So the net income is the total profit that a company makes after all of the expenditures. So after tax, after employee fees, after rent, after all of those costs, the money that the company is left over with from the revenue is the actual net income. The way that's worked out is you do revenue minus expenses. Something that has a positive net income means that they are making profit. It's as simple as that. And if it's negative net income, that means they are losing money. The next thing is the margins. So the margins is similar to the net income. The only difference is this is worked out as a percentage. So it's basically knowing that, so it's worked out as a percentage. So a high margin means that a lot of the money that the company earns is actually retained by the company. They're not paying as much in expenditure, whereas a low margin means, yes, they're making money, however, most of it is going in expenditure. So maybe tax, maybe, the cost of the building or things like that. So this is an example of Google in 2022. This is just an illustrated example. So on the left here, you've got all of the income. So you've got income coming from the actual Google internet, the browser. You've got YouTube, you've got Google Play, and you've got ads and things like that. So the total, it comes together and you get the revenue. So as you can see here, the revenue is 69 billion. And then from that, they actually take home 16 billion. So their margins is 23%, which generally speaking is very good. You can also see the gross profit here, so before some of these operating expenses are taken out as well. The next thing is free cash flow. This is how much money a company has to hand. This is important to know because if there's any sudden expenditures, then you will know that a company can be able to handle it. The other thing is it also gives them other options, so they can buy back stocks with this money. They can also reinvest this money elsewhere. They can buy other businesses. So a company with a lot of free cash flow, they can do a lot with it. The next thing is a positive free cash flow. It means that a company has extra money to invest. And a negative free cash flow means the company might be spending more money than it's earning. So the next thing is your gross margins. So similarly to net margins, the only difference is with gross margins, this is before some of those operating expenses. So net margins would be more important than gross margins, but it's important to look at both of them. A higher gross margin means that the company is making more profit from each sale. But a lower gross margin means that the company is spending a lot to produce its good, leaving less profits. So the next thing is earnings per share. So earnings per share show how much profit a company makes for each share of the stock. It's a way to measure how much money the company is making on behalf of the shareholder. So the way it's worked out is you get the net income, and then you divide it by the number of shares outstanding. So if I have a net income of, for example, $100, my business, and I have 10 shares outstanding, that means my earnings per share is $10 per share. A higher EPS means that the company is making more money per share, which is good. A lower EPS means that the company is not as profitable. The next thing is shares outstanding. The way I think of this, so it's quite complex, but the way I think of it is how much shares is there out there? How much shares does a company have? So this is normally on the balance sheet whenever they have earnings, but a high number of shares outstanding means that the company has a lot of shares out there. It's a way of diluting, whereas a low number of outstanding shares means that the company might be buying back shares and is more concentrated. The next section is more to do with the valuation side of things. So I'm going to go through each of these. So the first thing is your dividend conversion ratio. So this measures how effectively a company can turn its earnings into dividends for the shareholders. The way it's worked out is you get the earnings per share and then you divide it by the dividend per share. So a ratio less than 1 is bad. This means that the dividend is unsustainable. On the next slide, I'll show you an example of this. And a higher ratio means that the dividend is sustainable. I'm going to give an example from last year. So you've got a company, a healthcare company called 3M. Many of you might have heard of this. For those that are medics, this is the company that makes most of the medical supplies and even most of your stethoscopes. Last year they had an earnings per share of $1.70. However, they were paying dividends of $6 per share. So already you could see they are paying out more in dividends than they are actually earning. So this is instantly a red flag. So if you were to work out the actual conversion ratio, it was less than 1. It worked out at 0.28. This meant that it's unsustainable, and instantly if you look at this year, they've cut that dividend. And it makes sense because you can't, by doing this, you're just losing money, and they were never going to become profitable because of that. On the other hand, if you look at a company such as Microsoft last year, they had an earnings per share of $11 and they paid $3 per share in dividends. So you can see already that that dividend is affordable. And if you even worked it out as a ratio, it was just under 3, and that's pretty safe. That's as safe as dividends can get. So the next thing I'm going to look at is the PEG ratio. So the PEG ratio is similar to the price to earnings ratio that we went through, the PE ratio. The only difference is this takes into account the future growth of the company as well. The way it's worked out is you get the PE ratio and you divide it by the annual earnings growth rate. A ratio below 1 means that the stock is undervalued, and a ratio greater than 1 means that the stock might be expensive. Just bear in mind though, in a bull market, it's very difficult to find companies with a PEG ratio below 1. So sometimes you might still need to pay a bit over the odds. This is just an illustrated example. So this shows you the PE, so it's the price divided by the earnings per share, whereas the PEG ratio is the PE divided by the growth rate. The next thing is current ratio. So this gives you an example of how soon or whether a company can pay back money instantly if they do need to. So the way it's worked out is you got the current assets, you divide it by the liability, and it gives you a ratio. A ratio more than 1 means that the company has more assets than liabilities, which is a good thing because they can cover upcoming bills easily. A ratio below 1 suggests that the company might struggle to meet their short-term obligations, so it's kind of like a warning sign. And if I put that visually, an example of an asset is, for example, the building that the business is based at. Let's just say it's worth $35 million, and then let's just say you've got liabilities of £29 million. If you work it out as a ratio, it's greater than 1. So you can see that the assets is worth more than the liabilities. So if, for example, whatever happens and they need to get the money quickly, they can always get rid of the assets and it will cover the bill for this. On the other hand, if the current ratio was less than 1, that means your liabilities are greater than your assets. So if the liabilities ever get big, it's going to be a problem for the company. Next is your quick ratio. This is very similar to the current ratio. The only difference is the quick ratio doesn't take into account like your current stock. So if you have like stock waiting to be sold, it doesn't take into account that. So this is a more healthy measure of like liabilities and assets. So a ratio over 1 means that it can cover its short-term obligations without relying on selling anything. So that means it's really good in terms of financial health. And a ratio below 1 means that it might struggle again. The next thing is your economic moat. This basically indicates whether the company has a competitive advantage over other companies. So you got examples of economic moats. So the first thing is something like brand loyalty. So some customers might just prefer a company and they've got that loyalty towards it. And an example being Coca-Cola. Other examples is, for example, in healthcare, a company might make a new medication and they might patent it, meaning other companies, they can't copy it. So these are all examples of a positive economic moat. You've got Morningstar here. These guys, it's a company that's an analyst of stocks. So they make articles analyzing stocks and they give their ratings as well. So they give like a fair value and they give you the moat rating as well for it. The only reason I've put that here is because there are many analysts out there, but in terms of price targets, I think Morningstar are the most conservative and the most reasonable. But saying that, Morningstar, they're not perfect. There are some valuations where you might disagree with it, but I just use it more as an indication rather than something that's set in stone. And finally, you've got safety margin. So safety margin is essentially a buffer zone between the intrinsic value of the stock and a price chosen by yourself. So for example, if the intrinsic value of a stock is £100 and you give yourself a 10% margin, that means you'd be buying the stock when it's under £90. If I show you this visually, you can see the fair value of the stock being $100, and then you've got a 10% safety margin on each side, and then you've got a $90 target and $110 as like a maximum upper limit. So that means anywhere in this green range, less than $90, it's a buy, and anywhere in the red region, you'd avoid it. So that's a summary of my template that I've made. The next video that I'm going to make is going to be slightly longer, but I'm going to go through actually how to use this, where to find the information, and I'll go through a few examples as well. Thank you.